Hi there, I'm Edward Kaalstien, founder of EKH Capital, where we look for market-beating stocks for the long run. Today we're going to break down Airbus, Europe's aerospace juggernaut, from its dominance in commercial aviation to its growing defense and space programs. Airbus plays a critical role in global mobility and security. With Boeing struggling, Airbus has quietly built a backlog of 8,600 aircraft, strengthening its grip on the skies. But the question is Airbus a quiet compounder or an overvalued giant hiding in plain sight? Let's run it through our 5 key factors. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's jump in. First up, is Airbus generating high returns on capital? Airbus's return on invested capital comes in at just 3.6%, well below our 15% threshold for capital efficiency. On the surface, that's a red flag. But take a look at return on equity, which is sitting at 21.8%. Quite strong. And here's the interesting part. Unlike many US peers, Airbus hasn't relied heavily on buybacks to juice that number. In 2024, they executed only 0.3 billion euros in repurchases against an equity base of 19.7 billion euros. Return on invested capital is underwhelming, which is likely a function of the capital-heavy nature of aerospace. But the clean return on equity without the financial engineering tells us Airbus is delivering shareholder value the hard way. That earns respect. Next up, growth. Is Airbus delivering consistent results? Airbus's top-line growth has been slow, with a compounded annual growth rate of 0.8% for revenues over the past decade. But don't dismiss them just yet. Net income grew with a CAGR of 5.1%. Earnings per share also grew with a CAGR of 5.1%. Ending fiscal year 2024 with an earnings per share of 5.4 euros. That's consistent, and in this industry where production delays, supply chain issues and macro shocks are common, stability often beats flash. With Airbus now consistently outperforming Boeing in aircraft deliveries and sitting on a record order book, future growth may be more visible than ever. Strong growth is only sustainable with a healthy balance sheet to back it up. This is where Airbus shines. They have cash and short-term investments of 18.7 billion euros and a total debt of 14.3 billion euros. Looking at their debt-to-equity ratio, it's 0.6 and has been falling in the last few years. Looking at their free cash flow, they generate about 3.7 billion euros. That means Airbus could cover 26% of its total debt with 1 year's free cash flow, putting it in a strong financial position, as 10% is the bare minimum. Airbus has a rock-solid balance sheet with more cash than debt, declining leverage, and strong free cash flow generation. This is a fortress balance sheet by industrial standards. Even great companies can be poor investments if you overpay. So how is Airbus valued today? Now here's the tough part. Airbus has a price-to-earnings ratio of 32, with earnings per share growing at a CAGR of 5.1%. This results in a PEG ratio of 6.3. A PEG of 1 is fair value. At over 6, Airbus looks meaningfully overvalued, especially compared to Northrop Grumman with a price-to-earnings ratio of 21.2 and 11.8% earnings per share CAGR, Lockheed Martin with a PE of 23.6 and 7.7% earnings per share CAGR, and Boeing has currently negative earnings, so we cannot provide a meaningful multiple here. While Airbus offers stability, the current valuation implies premium pricing for modest growth. Airbus is a great company trading at a steep price. At these levels, it's hard to justify this as a value play. Finally, let's look at whether Airbus has a strong moat that can protect its profits in the long run. Airbus has a strong moat, especially in commercial aviation. With a global backlog of over 8,600 aircraft compared to Boeing's 5,600. They have a strong market share, now delivering more planes than Boeing year after year. Scale and complexity, with supply chains spanning the globe and certification hurdles across jurisdictions, This is an industry with formidable barriers to entry. Also, Airbus benefits from geopolitical diversification compared to Boeing's heavy US government exposure, and a dual strategy in commercial and defense aerospace, giving them both volume and resilience. Airbus's moat is big and getting stronger. It's not just surviving, it's dominating. Now before we wrap up, the clean, detailed charts in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link below for 15% off to level up your stock research at no extra cost to you. Is Airbus a quiet compounder or an overvalued giant based on our 5 key factors? Return on invested capital is just 3.6%, but return on equity hits 21.8%, and that's without any buyback tricks. Earnings per share grew at a CAGR of 5.1% over the last decade. Steady, but nothing flashy. The balance sheet is a fortress. Lots of cash and debt is under control. The PE ratio is 32 and PEG ratio is 6.3. That's a steep price for slow growth. Airbus dominates commercial aviation, and with a record order backlog, its edge just keeps growing. Airbus is a high quality industrial with strong financial footing, an impressive moat, and unmatched skill in commercial aviation. But based on current earnings growth and a PEG ratio of over 6, the stock looks significantly overvalued right now. Great business, questionable price. What's your take? Growth compounder or priced for perfection? Drop a comment, hit like and subscribe, and let me know which stock you want to see next. Thanks for watching, and I'll see you in the next one.